Good afternoon, everyone, and welcome to our most recent AML Watcher webinar. This time we're going to be discussing everything designated non-financial business and professions, or DNFBS for short. It's not exactly short, is it? We're going to work on that acronym. So what are DNFBS? Well, basically, these are entities that, whilst not classified as financial institutions, are still subject to AML and CFT regulations. And these play a crucial role in the financial system because they can actually be exploited by criminals to launder money and finance terrorism if they're not adequately regulated. So today, we're going to be looking at the common categories of DNFPS. Again, this is not getting simpler as an acronym. And we're going to be looking at their vulnerabilities, regulatory compliance around them, and just really looking at going forward what we're expecting to see from a regulatory perspective, and also an increase in controls and oversight, for example, with the establishment of AML coming through early next year. So without further ado, I would love to take this opportunity to introduce you to our esteemed speakers today. So first and foremost, we're actually sponsored today by Nice Actimize. So I'll take the liberty of introducing Adam McLaughlin first. Adam, would you like to introduce yourself?
Yeah, sure. Good afternoon, morning, evening, everyone, depending where you are. My name's Adam McLaughlin. It's great to be here. I'm a 18-year industry practitioner, ex-law enforcement, ex-banking, now come Nice Actimize. So I now head up AML strategy globally for the company. So great to be here.
Lovely. Thank you for joining us, Adam, and thank you for sponsoring. And next, without further ado, we have Kevin Newe from the HMRC. Kevin, I hope I pronounced your surname correctly.
You did, Oonagh. Thank you very much. Hi, everyone. Really great to be here. So I work for His Majesty's Revenue and Customs as illicit finances threat lead. So in addition to being a tax administration with law enforcement capability, we are also an anti-money laundering supervisor and cover a number of businesses that would be classified as DNFPPs, as well as money service businesses. So happy to share some insight and some experiences from how we work as a supervisor, but also some of the risk that we see from our investigations.
Wonderful. Thank you so much for joining us, Kevin. And last, but certainly not least, we have Gareth joining us. Gareth, thank you so much. Would you like to take a moment to introduce yourself?
Yeah, thank you very much. So I work for the City of London Police as part of their capacity as lead force for fraud and financial crime in the UK. I've been in law enforcement for about 18 years now. Most of my time has been in complex and major investigations and organised crime, and I specialise in fraud, financial crime, and most recently bribery and corruption.
Brilliant. Thank you so much for joining us. I hope we're not taking you off the beat by having you here today.
I think London would be in trouble if I was on the beat.
So without further ado, we're going to get into the questions. We would actually encourage all of our participants today that are joined us to actually ask questions. This is intended to be as much of a fireside chat as possible. So Kevin, if I might first and foremost just kind of asking you, obviously there's a lot of unique challenges in DNFBSs. Again, not getting shorter. When we're implementing AML controls compared to traditional financial institutions, what in particular are those unique challenges that we're seeing, and why are they so challenging?
So I think there's a couple of things. From our experience in terms of our supervised population, you've got a real mixed bag. So you've got professional firms, names that are well established, that can afford perhaps to invest in AML compliance functions and have dedicated resource to do that. So inevitably they have an element of advantage, shall we say, because they have people looking at this as part of explicitly their role, and are deepening their understanding of risk and therefore reporting as and when they need to. And then at the other end of the spectrum of our population, you've kind of got sole traders or very small companies where individuals are having to juggle all manner of responsibilities and be really mindful of, business generation and obviously selling their products and getting out in the marketplace and understanding what the competition looks like. And then in addition, kind of being required to do AML activity on top, and may not be able to invest to the same degree as some of the larger firms in kind of aspects of AML compliance that might improve the level of bureaucracy. So there could be a lot of manual reconciliation, a lot of kind of checking of various databases, and then not necessarily doing a lot of SARS reporting in terms of consistency, So, as and when they do, each time is kind of almost afresh for them. So that can be a challenge. I think also, as much as we do have a regular dialogue with our supervised population and we are talking to them about risk that we see as a supervisor, if we think about public-private partnerships, whether in the UK or internationally, unsurprisingly, a lot of them are explicitly a relationship between the financial institutions, because they are often the largest reporter of risk in any given jurisdiction, and they see, by volume and by value of risk, a significant amount of transactional activity. So it makes sense for law enforcement to speak to them on a daily basis, or at least fairly regularly. And maybe that level of dialogue doesn't necessarily happen as consistently with DNFPBs. And so, they are hearing from law enforcement, perhaps in very specific circumstances, and maybe not to the same level of frequency as you might have within a public-private partnership. So, understanding their risk exposure can be a bit of a challenge for them. And kind of, if it's a kind of new and emerging fraud or a new emerging type of money laundering activity, maybe they're going to hear about it second or third hand. So, for me, they feel like some of the big issues that might be a challenge. And then finally, the nature and relationship that they might have with their customers, depending on the services that they offer, will be, again, fundamentally different to a financial institution. So if it's a trusting company service provider, they could be dealing with someone semi-regularly, maybe even just a one-time transaction. What's our expectation of customer due diligence? If they sell a company to someone and then 3 years later it's implicated in a fraud or money laundering, can we realistically expect a company formation agent to have known that? They did their due diligence in the way that was required. So some of it's around the nature of the transactional relationships and then maybe the level of frequency. So in terms of like being at the vanguard of spotting risk, it's not always easy for them to do.
No, I think you make some very fair points there, Kevin. Budgets aren't the same. Are they always being invited to the table like larger financial institutions? Well, the answer is no. And if you go to conferences around the globe, do you really see these entities? Well, you see the law firms, but
Yes.
from the other perspective, are you really seeing them at the table? But really, really, really valid points. And I think, Gareth, previously when we discussed this as well, you mentioned about culture and the culture of compliance within these institutions and having that as a discipline. Do you feel that that's a real challenge as well?
Yeah, I think hugely. I think certainly in the financial sector and larger firms, it's pretty well baked into the way they do business. There's people with a lot of specialisms, and they're thinking about compliance as a fundamental part of the way they work, and then they're sort of dovetailing in with revenue generation or the other parts of the business. Whereas I think for sort of the designated firms and smaller firms, that's not the case. Particularly if a company is starting up or they're looking to up their game around compliance or regulation or new areas of business, or just trying to stay ahead of the curve of the sort of the AML threat, I think they have an uphill struggle. And part of that is because you're going to have practitioners having to kind of swap hats, think about money laundering and regulation, which is quite a separate discipline to their their day job, if you like. And in a lot of firms, there's a level of tension between, sort of compliance and the revenue generating side, and that's sort of resolved through, constructive dialogue and both sides understanding how the business works and finding, a good way through. But in a small firm, that dialogue is probably going to have to happen inside one person's head. And that's quite challenging because they're probably coming from a practitioner's point of view, a specific, area of business and a way of working, and then having to kind of transition to thinking about protecting the firm and regulation and anti-money laundering. And I think having to think in two terms at the same time, I think is a big challenge for companies.
Yeah. We used to refer to that, Gareth, as the schizophrenia of compliance. When you're constantly having to look at two perspectives and and two challenges, maintaining regulatory compliance whilst also ensuring the business is profitable. And they shouldn't be at opposite sides of one another. They should be together. But as you rightly said, there's a lot of education as well that goes behind this, and training and awareness. But if I might, before we kind of jump into kind of building the frameworks and the support that these firms need, what are the real money laundering risks that these entities are exposed to, and how does that compare or indeed differ from the financial sector? And I don't know, Kevin, if you want, or Adam, if you want to take that first.
Well, we haven't heard from Adam yet, so maybe we shouldn't. I'm not saying but Adam, you can go first, and then I'll deal with what I know.
Cheers, Kevin. So the money laundering, I think, look, fundamentally, the money laundering risks are no different to what other organisations face. Obviously, there is differences in terms of the relationship that these organisations have with their customers. Going back to a point that Kevin made, the banks, if you look at a lot of FIs now, a lot of the bank relationships are digital. Like, I can't think the last time I walked into a branch of a bank and spoke to a bank manager or a cashier in a branch. So everything I do with my bank is digital. It's on an app. It's on online. Some people do telephone banking, so you don't have that relationship with your banks that people once did. So a lot of their controls and their monitoring has to be done digitally. But then the DNFBPs, a lot of them will have face-to-face relationships. Like, if you want to go to a conveyancing solicitor, you generally have to physically go into the office and speak to somebody. People have accountants, whether it's one-off or whether it's an annual thing, whether it's a regular thing. You will often be a local accountant, or it's somebody you physically have a face-to-face relationship with. So they often have a closer relationship, I would argue, than any bank has with their customers today. However, the fact is, if you're dealing with a criminal, that criminal is still going to be utilising your services to integrate their illicit money into the financial system, into assets. For example, if it's real estate or estate agents, they're going to be buying a property with illicit funds. Okay, so arguably, I would say that yes, there is some nuances there, but ultimately, it's still, the fundamental fact is it's still a criminal with illicit wealth trying to get their money into a system, but using you as the quote unquote gateway in order to access the financial system. So you're the middleman or middlewoman, if you like, into the financial system. But fundamentally, it's still placement. It's still things like flow throughs. It's still circulation of funds. It's still it's still that placement element that exists within these DNFBPs. It just materializes itself a little bit differently.
But do you think, Adam, and again, I know Kevin and Gareth, you both have got some things to add here, but do you think that there are credible deterrents? And it's a fair question to these types of entities when they're looking at their kind of the ROIs, the returns on investment, they're looking at the bottom line. There's we're seeing a very different scale of enforcement action against financial institutions than we do against these entities. Is there really a credible deterrence happening in the market in terms of enforcement action and visibility of the likelihood of enforcement action?
I've got an opinion on this. I'm sure Kevin and Gareth have got an opinion as well. But look, my view on this is they have been underserved historically by regulation and also by enforcement. If you look at go back 20 years, for example, everything's been on the banks. Why are you not doing enough? You need to do more. Here's the regulation. Here's enforcement. Here's tighter regulations. Here's tighter enforcement. Here's bigger fines. But the fact is, yes, there's a big part to play for the banks. And yes, the banks see financial flows. Yes, banks move people's money. But fundamentally, these DNFBPs are enablers. These are the gatekeepers. A lot of criminals, especially you look at organised crime gangs, okay, anywhere in the world, you look at the cartels in South America, you look at the triads in China, you look at the Russian mafia, they've all got accountants, they've all got lawyers, they all probably use real estate firms, okay, they all use people like notoriety, formation agents, you name it, they all use these people to place money, and they put money into these firms in order to buy property, in order to do their accounting, etc., etc. But if you look at how many of these firms have been prosecuted, how many individuals have been prosecuted, it's tiny. And I suspect there's a lot more of this going on than we are prosecuting. And going back to my policing days, when we sort of looked at OCGs, organised crime groups, and I don't want to speak to Gareth here, but often some of the organised crime groups that came in once they got arrested, they'd all use the same law firms. That's not coincidence, right? It's not coincidence because they know that these law firms will operate for them. These law firms will take their money. These law firms will represent them. So they all know who will work for them and who will operate with them. And if you're a criminal, are you going to file a SAR? If you're a criminal organisation, DNFBP, and you know that your customers are criminals, are you going to file a SAR? Or are you just going to hope you're going to get away with it and you're not going to get looked at? And I'd argue, some of these firms just aren't filing SARs because they know they're criminals customers. They're just hoping they're small enough that they just fly under the radar.
And you raised, Adam raised an interesting point there, and I don't know, Gareth, if this is putting you on the spot, but recently I was having a discussion, and I believe the gentleman was from Interpol, and he was talking to the fact that a lot of these international criminal organizations are now working in collaboration with one another in order to increase the sophistication of the ways in which they can launder. Some have got specialized skill sets in one area, another in another. So, let's say you'd have the Mexican drug cartels working with Eastern European arms runners. Are you seeing a lot more of those kind of complex, or even Kevin, are you seeing a lot more of those complex organizations and networks working together? And again, I suppose the answer to that is it does make this incredibly more difficult to detect.
Yeah, absolutely. I think at the most sophisticated sort of end of the criminal spectrum, you obviously get sort of conflicts around sort of territory and things like this, but fundamentally they're businesses. They're looking to accrue as much wealth as they can and then launder it so they can use it. And I think that they're not above, setting up, complex companies and things themselves. But actually, if there's a service out there that's going to do it for them, then absolutely they will take that on. I mean, we're well into the days of the dark web and the ability to purchase sort of illicit services, illicit software, all those sorts of things for, anyone that wants to. So for big criminal organizations and the networks that they have, I think they have, a lot more capacity to exchange their different skill sets. And we had an example with prosecution that was, I think, the end of last year now. And the investigation started off as an investment fraud. But then the sort of the directing mind, if you like, was harvesting the personal details of all the fraud victims, all the KYC type details, to set up a money laundering network, using for unwitting mules to create companies, bank accounts, all these sorts of things. And then sort of the next stage of that sort of criminal enterprise was then effectively being paid to launder the funds from other organised crime groups through this network and then depositing the funds where they wanted. So it's setting up business as a service to other criminal enterprises. So absolutely, I think, some really specialist, really skilled people working in money laundering, and they're providing a service to other people for a fee.
Absolutely. And also you mentioned obviously about sanction, this about kind of money mules, I have to say, people to ask me a lot of questions around like, how are we seeing changes in like financial crime? And the truth is, it's actually not getting more complex. It's actually getting simpler, especially with money mules targeting vulnerable individuals. It's so simple. But Kevin, to sanctioned entities as well, which entity or which firms within this category are we more likely to see using or being used by sanctioned entities?
Yeah, it's a really good question. So it's quite broad brush. Sanctioned entities or sanctioned individuals will oftentimes, there's not necessarily a criminal nexus per se, in the same way that you might have with an OCG. Sometimes they are sanctioned because of an association to a regime that is considered worthy of being sanctioned. And so, there's an interesting thing about education there, and like people's understanding outside of financial institutions as to what that risk of sanction circumvention looks like and how they might be exposed. But I guess, if you think about how quickly sanctioned individuals want to move wealth before it's kind of frozen, there's been a lot of reporting about Russia and into crypto assets. So again, kind of more firmly in that financial institutions or financial services provider space. There's been a lot of talk about property in London and how much that is owned through corporate companies, which may be based in jurisdictions that don't have a huge amount of transparency with beneficial ownership. So you've got already real estate agents or estate agency businesses rather captured by that, particularly those that might service high net worth individuals. And And some of those sanctioned individuals would fall into that category. You've got company formation agents, whether based in the UK or more likely overseas, that are at risk of exploitation, or potentially, as Adam alluded to, an element of fully knowing what they are doing and who they are operating for, and building a series of complex ownership chains to make that sanctions implementation and enforcement extremely challenging. So those for me kind of stand out, I think. In the main, it's sort of that kind of company service provider piece and the estate agency businesses piece, but accountants can be equally liable too. I mean, it's across the spectrum of firms that are considered DNFPBs, but I guess for some that risk is more manifest than others, just in the nature of the types of assets that are usually associated to sanctioned individuals or entities, and that's primarily from a financial sanctions perspective. I guess if you're kind of thinking about trade sanctions, which are becoming more applicable to complement financial sanctions, then perhaps you are moving away from maybe your company formation agents and your EABs, and maybe that is more explicitly accountancy service providers that might be doing the books for a firm, for a company that deals in import export of a particular high risk sector. They could be seeing suspicious trading activity, all of a sudden a pivot from a direct relationship into a sanctioned country to one that is adjacent to it. And while that country is not directly sanctioned, they have to think about, is that a method of circumvention and getting restricted items into countries? So, think back to our first question about some of the unique challenges, all of a sudden you're having to develop a level of deep expertise beyond just money laundering. Mm-hmm. You're really having to think about sanctions as a thematic area of risk and how it might manifest in your business, and really have to get up to speed with that, while at the same time, knowing what money laundering methodologies are now, knowing about the risk of money muling and how that might impact your customer or maybe the services that you offer. So, we're really making it quite easy for DNFPBs by adding all this onto their plate. So just do more, everyone.
Well, I know, but it's also true. And it's actually one of my biggest bugbears when people say, "Oh, I work in financial crime." Well, what do you do? I work in AML. And it's like, that financial crime is a bit like AI. It's an umbrella term for fraud, CFT, tax evasion, cybersecurity, data protection, ABC. And I think that's something that we really need to consider here. In larger institutions, you have multiple siloed individuals, and I'm not saying that's the right approach, but doing all of these respective jobs and still not getting it right. And then you go into these smaller firms and you're asking one person to be jack of all trades, whilst also ensuring that most times the compliance officer is also the company secretary. And, they're also HR, potentially in some cases. They're constantly, doubling up on roles and responsibilities. So there's a lot of challenges. And that probably brings us very nicely into kind of regulatory scrutiny and regulatory focus. So I think we're all aware under the new EU AML package, there's been specific focus here on DNFBS, in particular, the focus on football agents and bringing them under the scope and under the regulatory oversight of AMLA. What are your thoughts? I think if I may go to Adam, to you first. Increasing the focus on them. Obviously, Kevin's already said, and I totally agree with him here on the challenges of these firms keeping on top of regulatory change. But what are going to be the challenges with the increased scope of focus and the increased scope of regulation? Like, are they set up and supported in the right way to be able to implement this in the right way and to protect themselves from potential enforcement?
Yeah, it's a really interesting point, isn't it? So I think what we've had a problem over the last few years with DNFBPs is the disparity globally in both regulation and enforcement. So as everyone probably knows, in the UK, DNFBPs to the largest extent have been regulated for years. The money laundering directives, they were probably in very early days. And you got the other end of the spectrum where places like Australia, America, South Africa, and pockets of Europe where DNFBPs were never regulated. Which is a crazy concept, really, that these businesses can, trade, they can do business with no requirement to report suspicious activity, no requirement to do KYC. But that is definitely changing. You talk about the AML, AMLO and the AML package that's come across Europe. Football's now come under scope. Also, high value businesses like I think car dealerships, precious metal dealers, art dealers have now come in scope under the new AML package in Europe. The US have just brought real estate into scope for regulation, and then tranche 2 in Australia is now bringing DNFBPs within the scope as well. So there's definitely been a shift over the last sort of 18 months, 2 years, in terms of bringing organisations to scope, but there are still gaps globally with this. However, going back to Gareth and Kevin's point, it's the enforcement of it. It's all very good regulating them, but it's enforcing it. There's only so many organisations, there's only so many regulators to enforce these businesses, and these businesses number thousands, if not tens of thousands, if not hundreds of thousands, right? Compared to banks, there's a lot of family offices and family businesses and one-man shops and sole traders and so on and so forth who come under scope of regulation, who could be doing completely illegal stuff, not reporting, not doing KYC. How are you going to? My question is, how are you going to enforce that? How are you going to regulate every single business? How are you going to do supervisory visits in every business? It's a tall ask, because even banks, regulators trying to get around all the banks is a difficult job, and there's a lot less of them than before the DNFBPs exist jurisdictionally. So, and then also Kevin's point, a really strong point there is around, you've generally got a sole trader who's an accountant, he runs his own business, he's got to be the accountant and the admin and the HR person, and they've got to be a compliance officer. Okay. They don't have training on this. The guidance from regulators is take a risk-based approach. Well, if you don't know what that approach is, how are you going to take a risk-based approach if you don't know what it is in the first place? So I think the challenge there's got to be a bit of training, but also we have to work out how we can be effective at enforcing regulations, because regulations are great if you can enforce them. If you can't enforce them, it's just a bit of paper, right? Saying you must do this, you must do this, you must do this. And so that's my question: is how are you going to enforce it? And I question whether there's enough people and resources to enforce across all the DNFBPs that exist.
What do you think, Kevin, on that? Do you think we're going to see more enforcement? I'm not putting you on the spot here, but I am.
Yes. That's fine. That's what I'm here for. So it's interesting in the UK context, colleagues in the National Economic Crime Centre, of which HMRC supports and contributes to, have earlier this summer released their professional enabler strategy. And we can get into a really long technical debate about what constitutes a professional enabler, and are we talking about those that are criminally complicit in the way that Adam described, or those that are negligent and spectrums of negligence? Is it willful? Is it naivety? Is it somewhere in the middle? But a part of that is very much pushing much more into the regulators and supervisors and saying to them, law enforcement or criminal investigation has its place, but particularly in the UK criminal justice system, it's not practical to start loading in hundreds of DNFBP cases. Not that we have hundreds, but that's just not practical from when are they going to be heard and the consequences of those. So what can supervisors and regulators do to complement our investigative capabilities and work more effectively as a system? Because we keep talking about ourselves as a system, and I totally agree with you. Financial crime is a very broad church, but ultimately, you've got economic and national security considerations, and we should be really thinking through that lens as a collective, not kind of how do I mitigate my risk so my supervisor doesn't give me a slap on the wrists. So I think we will see probably a drip feed of increasing, let's call it compliance activity in the first place, which will then, depending on the nature of the risks identified and the potential breaches of regulations exposed, could then lead to enforcement action. And then, within that, are you talking about quite a substantial financial penalty, and then, changes made to a business? Are you talking about the potential for prosecutions under the regulations in the UK, which, the custodial sentence is a maximum of 2 years? Is there a deterrence in that? Interesting question. What other sanctions can be applied? Is there a kind of an aspect of naming and shaming? I know in certain overseas jurisdictions, so when I've spoken in Jersey and Guernsey before now, for a company formation agent to be found with their hand in the till, for want of a better metaphor, that's them done on that island. They have to leave. They are very protective about their reputation. And so, while prosecution might not be viable for whatever reason, that person's done in that sector. Thanks very much. Goodbye. So I think we have to look at what are those enforcement capabilities that are available to us, and what's the right thing for the circumstances of that case. Because some of the regulatory breaches will just be negligence or, a naivety on the part of the individual because they are a one-man band. And I've got HR issues, mate, never mind compliance issues. Although if they're a one-man band, what HR issues do they have, we wonder. But anyway, but I think, that kind of using the tools more effectively is certainly something that's kind of a key constituent part of that professional labour strategy. But I really take Adam's point. I think a lot of this stuff, we think of financial institutions as interconnected, as well they might be, because they have subsidiaries here, there and everywhere. But maybe we don't think about DNFPBs in the same way. And actually there is sometimes relationships with those providers that is cross-jurisdictional. And so, if in the UK they are regulated, but then in Australia they are not, you've got that opportunity for regulatory arbitrage and for criminals to exploit different parts of the system. And so rather than go direct to a formation agent in the UK, they are using someone somewhere else in the system and then passporting into the UK under the guise of some sort of, simplified due diligence because we think they're regulated, or maybe they're not. So I think, we need to start thinking about the DNFBP risk in a much more, cross-jurisdictional sense than perhaps we do now. Certainly from the UK's perspective, a lot of the big laundromat schemes, which didn't originate in the UK, were using limited liability and Scottish limited partnerships. Now, they could have been formed directly because at the time it was relatively easy to do that, but Companies House transformation will hopefully mitigate some of that. Or it could be using an offshore formation agent who's then passporting into a UK formation agent, and then, they're exploiting actually the regulations to basically launder in plain sight. So I think that's going to be a challenge for us from an enforcement perspective, more domestically, but then how do we scale that to be really effective internationally?
Yeah, and I know that I know Gareth Mackenzie and the team up at Law, the Law Society for Scotland have been doing a lot of work there around educating on those specific points. And I think it's fair to say that the industry is becoming better. I'm sorry, Kevin or Adam, you wanted to make a point there.
Yeah, just one thing that Kevin said, which is a challenge, because obviously the title of this is about DNFBPs versus financial sector, and I think one challenge is obviously the financial sector are very tight in terms of regulation. So they have to be, right? They get supervised a lot more regularly. The fines are generally bigger, and so they're a lot more established. They're a lot more mature as organisations. However, the biggest challenge I feel that there is for the financial sector is DNFBPs obviously operate as businesses, and they've got multiple customers. You look at an accountancy firm, real estate, they're not just servicing one customer, they've got multiple customers, and they'll also have bank accounts. These businesses will have bank accounts. So the bank account being the name of the business, not the underlying customer. And so you have this omnibus account issue. So, if you've got a DNFBP that's operating with criminals knowingly, any money deposited will be deposited under the business name, not under the criminal name. And so the challenge then is, as a bank, KYC then becomes a much bigger issue, because what you're seeing is money going in and money going out from a estate agency firm or an accountancy firm, often without the underlying, well, who's this money from, who's it going to, so you don't have that connection between the source of the money and the deposit. So you're doing transaction monitoring on the business, not the underlying customer. So that's a really big challenge, I think, for some. And it's not always the case. Sometimes you can see who the underlying customer is, but not always. So this whole omnibus issue is a challenge.
Yeah, it's interesting, actually, you raised that. This is a discussion that I keep coming back to around time and time again. Even yesterday, somebody was asking me about use cases for blockchain. And this is one of those very, very simple use case scenarios. The case I was talking about was specific to where people are being paid for third-party platforms that are then using payment gateways to transfer the money through to financial institutions. And financial institutions don't have that look through to the underlying who the clients are of the platform. Like we're talking YouTube or OnlyFans or whatever type of social media platform people are gaining money from. And a use case here would be obviously blockchain technology. And similar to what you've said, we have, obviously, if we look at not that it's comparable, but if we look at correspondent banking within Swift messages, it's very clear. We have it clearly set up in terms of the movement, who the actual originator is, where it's going through the banks, who the recipient is. We use the 200 series message specifically for that. But we haven't really thought about that problem statement. It is a problem statement, but we haven't really thought about the real solution here for these types of entities that will give us that complete look through. And I suppose if we look towards future technology use cases, blockchain technology is a fantastic utility for that. But again, I appreciate that there's a lot of considerations and challenges around implementing that as well, especially if you're asking non-regulated firms to implement requirements before it hits the regulated entity. So Kevin, go ahead.
So just one further thing, and then I'll pass it. But on that point, unless you've got some auditable, independent process to check the source to the destination of the funds, the problem with businesses, and I've seen this again in law enforcement. I'm sure Gareth's seen it. I'm sure Kevin's seen it. Be able to hide your tracks and create a fake invoice or a fake, paperwork to justify where the money's come from and who you're paying. It's not hard, right? You got some letterhead, you got business headed paper. It's so easy to create fake paperwork to justify your transactions. It makes it a lot harder for law enforcement to untangle that and work out where the source is, who's who, and so as a business, it makes it hard to track it. So if that independent thing would really help.
Yeah, I'm going to play devil's advocate here. Isn't that the problem we have in trade today? It's exactly the same problem in trade-based money laundering. And we saw the Singapore use case where they tried to implement blockchain, but as you rightly said, it works within country. But the problem with trade is when you have approximately 92% of entities being funded by open source financing, which is outside of a regulated ecosystem, then you have a bigger problem. So yeah, I fully get it. I'm just kind of, we need to start coming up with some solutions and some pragmatic solutions that are also going to be a defense for these entities so they can rely on more information. At the moment, I think a lot of these entities are struggling because they're trying within the best of what they can see, even one degree of separation, to obtain information. But when you don't have visibility outside of that first or second connection, then you're going to have potentially we see it in sanctions a lot as well, where you have a non-intentional, connection to a sanctioned entity. And I think, unfortunately, that's more and more of what we're going to see. So enforcement actions and penalties are going to be increasingly on the horizon. We've seen that through the increased regulatory focus. One of the things that might be useful before we go into talking about what firms can do in terms of improving their compliance frameworks to support this is, if you don't mind, Gareth, just to bring you back into the conversation, not that you've been a bit quiet, if we break it down by real estate agents, lawyers, accountants, is there specific types of trends that we're seeing within these different types of entities that differ from one another? Or is it much the same in terms of the types of, financial crimes that we're seeing going through their books?
I think there's a lot of variety, and I also think that the imaginations of organised criminals is limitless. Where there's an opportunity for exploitation within a system, whether it be for committing fraud or importation of illicit goods or money laundering, they're going to find a way. And I think just thinking down to the different different sectors we're talking about, probably in a lot of areas, it's probably not that different in terms of trends to what you would probably imagine. So I know that the sort of like the gaming sort of casino industry, they're obviously, I think they're very aware of the potential for money laundering, cash money laundering. And there's a huge sort of reputational risk for them around that. So I think probably they're probably towards the top of those industries, I think, that are probably most active in general terms. Obviously there's, it varies, but probably most active in thinking about identifying those people bringing cash in and not really gaming and then trying to cash out, regular customers, high transactions, those sorts of things, which is, I think, is a clear risk. Real estate, art, I think we've already talked about sort of oligarchs and the movement of funds into the UK. I think that's probably one of the big trends around those. The high value art is obviously it's transportable. It's easy to change hands and so forth, and it's not really sort of tracked or audited. Real estate, you wouldn't have to spend much time crossing London before you got to pockets of properties that are owned by shell companies, complex entities, trusts, overseas billionaires. And some of these are also being used secondarily to earn money as well. So they're sort of revenue streams on top of the initial purchase with illicit funds. So that's bringing a kind of a legitimate, semi-legitimate income to criminals inside sort of the jurisdiction, secondary to the money being laundered in the first place. Precious metals, precious stones, obviously small, high value, hard to track, unregistered, very easy to purchase, to stash, to change hands as well. We've seen instances of people within organised crime groups being paid in, gold and so forth. Obviously, Rolexes was traditionally the favoured commodity to sort of hand over items, but just gold bars, those can be done at volume as well. Thinking about sort of international trade, high volumes of metals and so forth, that can be done. Almost by sort of investment trade, but also physical movement of assets as well across borders, and that's a part of money laundering, right from quite low level right through to very large scale international organisations. We did sort of warrants not so long ago, and we found £300,000 worth of gold bars in a safety deposit box associated with a money launderer. So you are seeing it being used. And I think the sort of legal accountancy type areas, potentially they're the most exposed because they can sort of come into contact with firms in so many different ways. Obviously, day-to-day services for people and firms who are moving illicit funds or perpetrating other types of crimes is a risk. But also people and companies that looking to set up complex structures internationally, and the sort of the complexities around supply chains and all these sorts of things, which are they're used to launder money as well. And all of these sorts of things are going through law firms and accountancy firms and so forth. So I think there's a whole range of different vulnerabilities across the spectrum within that sort of designated section of business.
I think interestingly, and especially what you say there, Gareth, about kind of precious metals and stones, it's the typology hasn't changed over the years. It's still the same typology. The challenge is detection. And, I've been involved in kind of outsourcing arrangements and setting up free ports, for example, across in various locations around the globe. And that, the regulatory scrutiny that's on that, when you can fly in on a plane, pick up a pallet full of gold and fly back out again, undetected, so to speak. It is challenging. Okay, so let us talk then about what we can do to help. So obviously, one question that came through was, Kevin, you might like this one. What should we focus on in terms of prioritizing in sanctions compliance? Do we need to cover everything, or can we focus on just some specific sanctions?
So this is a good question. I found myself increasingly becoming a sanctions expert unintentionally. So it can happen, everyone. Have faith in that. So look, there's some interesting stuff going on at the moment in terms of analysis where kind of trade has displaced primarily from Russia. Let's kind of focus on that. And we've seen growth in exports into countries adjacent to Russia. And I guess, so some things will lend themselves to being repurposed for potential use on the battlefield. And I was doing a panel about sanctions a couple of weeks ago, and someone from a firm called Sanctions SOS was talking about like a growth in washing machines in Uzbekistan, because then either that they've got like a massive laundry problem and everyone wants to get a hot point, or they realize that they can repurpose some of the stuff from within and it can be used in military hardware. So some of this is hard to pin down because as kind of Gareth's alluded to already, you're talking about really quite clever people that are exclusively putting their minds to how they can circumvent regulations and oversight, and they're always thinking about different ways. And so can we realistically match that level of understanding of, is a washing machine going to be repurposed into using drone technology? I think that's probably a stretch too far, but I think it's kind of, what does my client or my customer or my trade exposure look like? So obviously it's no longer direct to Russia, because that would put me in breach of sanctions in a quite significant way. But have I seen a growth in one of my clients, like now pivoting exports into countries that sit around that? Maybe there's something there that I need to at least alert the authorities to. And I guess, a challenge is the level of reporting that we see across DNFPBs probably doesn't, match the risk profile in the slightest. And while my colleagues in the UK Financial Intelligence Unit would not want me to say, just report more SARS, wouldn't that be great? Because we have, upwards of 900,000. There is something about either having a dialogue with the likes of the Office for Financial Sanctions Implementation or the soon to be introduced Office of Trade Sanctions Implementation, just to kind of get a sense of, I think I've got this risk exposure, or I've seen this kind of growing or developing. What should I do about it? I want to make sure I'm compliant. Is it a referral into you guys? Is it a SAR? Is it a combination of the two? So I guess I would encourage firms that feel like they might have exposure to have that dialogue with the regulators or supervisors in that space. And HMRC does have an enforcement responsibility for some trade sanctions. But I think, this is a really interesting dilemma, because, it also speaks to Gareth's point. Russia is like a third or fourth largest country for gold. And obviously all of that has been pressed down upon. And so again, you would imagine it's like that direct country A to country B relationship has been compromised. But because of the nature of supply chains, we're seeing, gold that's potentially conflict gold or sourced from Russian refineries moving into sub-Saharan Africa or Western Africa. And, it's so easy to manipulate a gold bar to kind of do away from where it's been originated from, either through manipulation of paperwork or recasting of the gold itself. We've heard of cases where there's like smelts in people's houses or commercial premises in the UK rather than in a kind of established refinery, and all the risks to life that might bring. So I don't think there's like a specific thing one should focus on. I think it's like, what's been sanctioned, what countries, what individuals, what entities, and then who borders that country, what kind of level of sympathy have we heard from those jurisdictions, or are they sanctions agnostic, and could they be a potential supply chain route into for restricted goods or goods that could be repurposed? So I guess that's not a particularly helpful answer nor a specific answer, but I think it's some of this stuff is just about kind of trying to do one's best about clarity of what that risk exposure looks like.
But I think you raised a very important point there, Kevin, on innovation as well. It's, if we look at dual use goods, you don't automatically think of a washing machine. And so we're constantly having to think, as technology advances, do we know the components within certain pieces of hardware technology that could be repurposed? And the answer is, well, no, people on the street wouldn't necessarily have that information. So it's going to be interesting to see how that, how especially FATF take that under their wing in terms of the guidance around dual use goods in particular. So conscious that we have around 10 minutes left, and we're getting some questions through here. One of the questions that I'm seeing here is about trends. So I think, regulatory trends we should be aware of. We've talked about AML. We've talked about kind of changes in approach to oversight and regulatory oversight. Regulatory changes on the horizon outside of what we've seen in Europe. I don't know, Adam, is there anything additional to add to what we've already mentioned earlier around tranche, etc.?
No, I think I covered it mostly earlier on, but there is definitely an appetite for focusing on DNFBPs by the regulators, I would say. And one thing I didn't mention, I don't think I mentioned anyway, was South Africa. Even they grey listed and they've got grey listed. They've started introducing some DNFBPs into regulation as well. So it's not just Europe, it's and Americas and Australia. It's also other parts of the world as well. I do think we're going to see an increase in regulatory focus on DNFBPs. The challenge, though, like everything, is you're still going to have disparity around the world in terms of who regulates and who doesn't. And the danger with that is, we can have the strongest regulation in the world on DNFPs, and I think the UK probably arguably has one of the strongest regulations on DNFPs globally, because we pretty much regulate them all. But all that's going to happen is you're then going to push those organisations, especially if they're criminally operating, into countries where they either can bribe their way out of criminality or prosecutions, or they can just hide because the regulators and the governments don't really care. So I think you're going to start seeing that drive out to other parts of the world where it's maybe not taken as seriously. But I do think, going back to another point, is enforcement. We have to ensure that the regulations is backed up with enforcement. Are they filing enough SARs? Well, it's a very subjective test, right? Going back to Kevin's point, are they filing enough? I would probably argue not. If you look at the numbers being filed by DNFBPs versus financial institutions, it's a very small percentage. But I think we do. But then it's a resourcing issue. So there's lots of challenges there. I do think the focus will be increasingly on DNFBPs, but it's how we can manage that from a resource point of view.
By the way, Adam is not encouraging CYA SARs to be filed. That's cover your ass SARs.
That's not what I'm saying.
Please do not go back to your desk today and start sending out loads of SARs, or schedule them to go out over X period of time. But also as well, moving on from that, importantly, the cost of compliance, systems and controls. One of the things that we've made the mistake of in traditional finance is an over-reliance on manual controls, which frankly don't work. We need automated controls. We need to implement, obviously, technology in the right way that's appropriate for the business, appropriate for the products, and also works for the business, that we understand it. What more can entities within kind of the DNFBP space, what more can they do to better, I wouldn't say look at the way that the compliance costs are being allocated, but how can they get a more customized, automated framework in place that enables them to focus on where the real risks are? And by the way, that's a problem across the industry. It's not just it's everybody's struggling with it. But is there any words of advice that we can give to these firms on where they should start or how they could start? I don't know if anybody in particular wants to pick that up.
Shall I start off?
Yes,
so for me, I
please.
think, and I guess in many ways it comes back to the same sort of approach as bigger firms and the financial sector, and it's having a robust understanding of what your risks are. That comes down to being very focused on like your own sector, your own business type, your own geography, your own clients, and what those sort of trends and differences entail. Probably more so in this area than in the sort of financial sector, that an off-the-peg approach is not going to work. And as much as the sort of signs of money laundering may be the same across the different sectors, but how that plays out is going to be different, from sector to sector, firm to firm. So I think having a kind of a robust and bespoke understanding of what the specific threats that the firm is facing, whether it be, a law firm who deals with international corporates, or accountancy firms that deal with tax, or whatever it happens to be, is getting a really thorough understanding of what threats they are facing, what the trends in the industry are, and then tailoring the response to that. So not having that off the peg approach, but actually thinking, well, we've got a finite amount of time, we've got we might have staff double hatting, we might have a small amount of money, so where do we need to have where can we get the biggest bang for the buck? And that's going to be down to tailoring it towards risk for me.
And some of the questions coming through are, in terms of the view of outsourcing compliance and relying on third parties. Again, I think we're all aware you can't outsource your obligations. But Kevin, I see you nodding there. What are the views here around this in terms of maintaining oversight and control?
Yeah, I totally agree with your point, Oonagh. Like, ultimately, the regulations speak to you as a firm. If you think, given the nature of your business, and I totally agree with Gareth's point about, who knows their services and their sector better than you and therefore your customers. And speaking back to a point Adam made about the kind of consistency of relationship and the fact that a lot of it can be face-to-face, maybe not as transactional or technology enabled as you might see in the banking system. But I think it can be attractive to consider, like, this is going to solve my problem if I just give this responsibility to this firm over here, because they've promised me quite a lot for a relatively modest price. And I think every time I have a conversation or I'm part of a panel discussion about, you know, the ability of technology to bear down on compliance costs, or at least mitigate some of the consequences of them, most people who have been around this world for some time acknowledge there will always be a need for some form of human intervention somewhere in that system, usually towards the end, you know, making a decision about whether to do a trade or potentially submit a SAR or some combination of the two. So I guess, you know, I think it's about understanding the opportunity for you as a business, but being really clear within your mind, but also that conversation with a third party supplier. What does that interaction look like? How and when does a thing come across your desk if you are an individual, or maybe have a team of, lucky enough to have a team of compliance capability available to you, to really, because like the regulator isn't going to go and sanction that company necessarily. They're going to say to you, well, it was rather foolish to put all your faith and trust in that system. You do have a, you know, it speaks to you as the MLNO or the appropriate person. So, you know, recognize there are opportunities, but by all means, really ground yourself in the sense of, like, ultimately it comes back to me, and am I clear that what I'm getting from that company is what I need, but also it's giving me a really clear understanding of what that risk exposure looks like, and whether I say yes or no to that relationship, or yes or no to that SAR. So by all means, embrace the opportunities, but I guess the word that's kind of coming to mind is like a healthy level of skepticism, but also an element of realism in, like, what that means for you as the MLNO, or the person ultimately who could be sanctioned, as in face an enforcement action for not getting it right.
Yeah. One of the things I found incredibly useful very early on in my career was these kind of monthly or quarterly Chatterhouse Rule meetings where we had with our counterparts in other trade FIs. You know, for example, you know, we would have the head of financial crime from various different banks, they all coming together to discuss, you know, non-Pacific, you know, issues, but issues that were impacting all of us. And we talked about it earlier on today about public-private partnerships. We've also seen in a lot of countries as well, even the HKMA announced today a real drive about information sharing across financial institutions. For me, your compliance framework is all well and good. Build it as you need it, in line with your risk appetite. But the only way it stays relevant if it's continually updated with the new and evolving information on new typologies and understanding of the landscape. And in order to get that, we need to be proactive. And I think, Gareth, you know, you talked about it earlier, talking about the scale of money laundering. You know, no one sector or sectors could be expected to tackle this issue independently.
Yeah, exactly so. I mean, the levels of fraud, of financial crime, moving proceeds from other areas of criminality, it's absolutely, you know, it's absolutely vast. I mean, fraud, they talk about it being, I don't know, over 45% of all crime in the UK. And obviously that has to be laundered. And then you think about all the rest of it that's from drugs, human trafficking, and then everything else that happens, you know, internationally. The sums are astronomical. And as much as, you know, the banking sector, you know, there's a focus by regulators on them as being the sort of the sharp end, if you like. The fact is, and as we've covered earlier in the conversation, that there's vast amounts of information sat within other areas of business, you know, other sectors and things that be absolutely illuminating for, you know, banks or for law enforcement or for HMRC, that we just don't have access to. And I think having a joint approach, a shared responsibility for sort of tackling this threat, and shared ways of communicating information and intelligence in secure ways is absolutely critical. I don't think there's any other way we can sort of make a dent in the money laundering problem without it.
Absolutely. Well, conscious of time, I think we're just out of time. So I think it's very fair to say that these entities are vital to the integrity of the financial system, but they face significant challenges in the fight against financial crime. Regulatory and scrutiny is going to be increasing, and it's imperative that these entities enhance their compliance frameworks by investing in training, adopting risk-based approach, but also working across the board, not just within the DNFBS area, but also working with trade FIs, learning from what we've done well and what we haven't, so they can incorporate that into their frameworks. You know, these individuals within these firms are also struggling with multiple roles, not just compliance, but other roles within their ecosystem. So let's take a minute to think about that and see what more we can do. So if I may ask very quickly for each one of you, just round the table, would you mind just giving them very quick takeaway? So Kevin, if I could start with you, if you wouldn't mind just giving a very quick kind of, what is your key takeaway from today's session?
Why'd you go with me first? That's not fair.
Mm.
Right.
Gareth.
So I think, you know, I think the kind of point we're ending on there, that kind of public-private partnerships, I know it's a really pithy term and everyone's like, it's the solution to all ills. And there's much more to unpack than just that. But I think, you know, supervisors and regulators, law enforcement really need to kind of increase their dialogue with DNFPBs. You know, maybe the level of risk isn't as significant and the volume of traffic through those firms isn't significant. But as Adam and others have alluded to, you know, where they can be enabling, it can be substantial and significant. So if you're in the UK, you know, let's kind of have that dialogue under the auspices of the National Economic Crime Centre. If you're in another country and you know there's a PPP, try and push into it. Have a conversation with whoever is the facilitator of that, and try and get your voice heard around that table, or be representative of your sector. Because, you know, for me, the only way that we're really going to start to develop a more sophisticated approach to risk management is by, as you said, having a much more holistic and much more mature dialogue than perhaps we do currently.
Perfect. Thank you, Kevin. And Gareth, to you.
So for me, I think within firms, regardless of size, governance and leadership are really important. So sort of setting that the cultural expectations around regulatory compliance and awareness of AML, making sure that people at every level and every area of the business, they understand what the risks are, how to report, and that they're supported up to, you know, the highest level in order to do that, I think is really important. And, you know, we see firms who don't have that sort of culture, or regulations are sort of sneered at or seen as an inconvenience, and they're putting themselves on offer. So I think it's really got to be a kind of a cultural embedding of AML and regulation, and sort of being part of that sort of like bigger fight, if you like, that Kevin was speaking about.
Thank you so much, Gareth. And last but not least, Adam.
Yeah, so I think my takeaway here is, you know, the focus on DNFBPs isn't going to go away, and I do think it probably enhance. And my point here is, you know, you've got a greater relationship with your customer, but do you actually understand your customer? Is the question I've got to take away with you. And what I mean by that is, you know, you don't rely on what the customer tells you. How you validating, how you verifying, you know, what third-party information is available on that customer to make sure they are actually who they say they are, and make sure that you understand who they are, how they meant to be transacting, whether it's in line with the expectations, all that sort of thing. That's what you now have to consider, because if things aren't aligning, if things aren't as you expect, then you have a obligation to report a SAR. I'm not saying go away tomorrow and file hundreds and thousands of SARs. So I'm sure the UK FAU and other FAUs won't be happy. But if you are suspicious, because you better understand your customer, then file a SAR, because that's the only way we're going to fight financial crime, is by having an understanding of your customer and filing when things are suspicious and don't look right.
Perfect. Brilliant. Well, gentlemen, thank you so much indeed for joining us today. A big thank you to AML Watcher for hosting this webinar today. If you have any further questions for any of us, please reach out to us individually or via AML Watcher. But on that note, thank you so much for joining, and we look forward to you joining us in our next webinar.
Thank you.
Thank you.